I tested Bilt 2.0 hotel credits, and here's the truth. Before we dive in, some ads may appear during the video. Your support allows this channel to keep sharing valuable information for free. Now let's dive in. If you have been wondering whether the Bilt Rewards card's updated hotel credit structure actually delivers what it promises, or whether it is just clever marketing dressed up as value, this video gives you the unfiltered, tested truth. I personally ran this through real-world scenarios, analyzed the financial mechanics behind it, and I am going to break down exactly what high-income cardholders, business owners, and strategic spenders need to know before making a capital allocation decision around this card. By the end of this video, you will understand precisely how the Bilt 2.0 hotel credit mechanism works, and more importantly, how it fits within a broader liability architecture. You will know whether the credit is genuinely accessible or structurally restricted in ways Bilt's marketing does not emphasize. You will be able to calculate whether this card earns a place in your wallet from a cost of capital standpoint, and you will walk away with a clear institutional framework for evaluating hotel credits on any rewards card going forward. Grab something to write with. What I am sharing today reflects the kind of analysis that financial planning firms and premium advisory practices routinely charge several $1,000s to provide, and you are getting it here for free. Let us start with the baseline. The Bilt Rewards card relaunched its benefits package, what the market has loosely called Bilt 2.0, and the hotel credit component became one of its most talked about enhancements. The Bilt 2.0 credit structure repositioned the card as a serious travel and lifestyle instrument rather than simply a rent payment vehicle. On the surface, the promise is compelling: meaningful hotel credits that reduce your effective cost of staying at partner properties. But here is what most commentary misses. The credit is not a straightforward statement credit applied to any hotel charge. It operates within a curated ecosystem, specifically tied to Bilt's hotel partners and the Bilt travel portal. That distinction matters enormously from a capital efficiency standpoint. When a credit is portal dependent, you are trading booking flexibility for cost reduction, and that trade-off has real financial implications that sophisticated cardholders need to price in before celebrating the headline number. When I ran the Bilt hotel credit through live testing, several structural truths emerged that you will not find in the press release. First, the Bilt hotel credit access through their travel portal did post reliably. The mechanism itself is not broken, but the rate competitiveness of the portal booked rates versus direct hotel rates or third-party OTAs varied meaningfully depending on the property, the dates, and the market. In some cases, the portal rate was at parity or within a few percentage points of booking direct. In others, the portal rate carried a premium that partially or fully offset the credit benefit. This is not a condemnation of the program. It is a financial reality check. Capital efficiency optimization demands that we evaluate the net position, not the gross benefit. If a hotel credit saves you $50, but the portal booking costs $60 more than the direct rate, your net position is negative $10, and you have also sacrificed elite status recognition and direct relationship benefits with the hotel brand. That is the full picture. And that is the kind of analysis I tested across multiple properties and price points. Now let us talk about something that rarely gets discussed in the context of hotel credits: the float period strategy embedded in how you use this card. For S-Corp owners, LLC operators, and high-income professionals who are actively managing quarterly estimated tax obligations, the Bilt float period strategy is genuinely relevant. The Bilt card, like most premium Visa products, operates on a standard billing cycle that, depending on your statement close date, can provide between 28 and 55 days of interest-free float on charges. When you are booking hotel stays for business purposes, and those stays are legitimately deductible under IRS substantiation requirements, meaning they serve an ordinary and necessary business purpose, are documented with receipts and business purpose notations. That float period allows you to time payment into the following tax period in certain circumstances. Consult with a qualified tax professional on your specific situation, but the structural opportunity here is real. The Bilt Card's hotel credit effectively reduces your cost basis on a deductible business expense, which means the after-tax value of that credit is higher than its face value for high marginal rate filers. A hotel credit on this card does not exist in isolation. It sits within the broader Bilt Points transfer liquidity framework, and that context is critical. Bilt's transfer partner roster, which includes programs like Hyatt, United, American Airlines, and several international carriers, provides what institutional analysts would characterize as optionality value. You are not locked into a single redemption path. The Bilt Points transfer liquidity mechanism matters specifically because hotel credits, in the Bilt architecture, interact with your points accumulation. Properties booked through the Bilt portal may or may not earn hotel loyalty points simultaneously, and that distinction affects your total return calculation. When I modeled this out, the scenarios where Bilt portal bookings forfeited Hyatt or Marriott Elite night credits represented a meaningful hidden cost for status-chasing travelers. For those who have achieved top-tier status with a hotel brand, the opportunity cost of a portal booking can exceed the dollar value of the Bilt credit itself. This is not an argument against the card. It is a framework for knowing exactly which traveler profile benefits most from this structure, and we will come back to that in the verdict. For business owners evaluating whether to run hotel expenses through a personal card like Bilt or through a dedicated business card in a separate entity, the entity structure and Bilt card question requires careful analysis. The Bilt Rewards card is a personal card. It is issued to an individual, not a business entity. That matters for liability separation, which is a cornerstone of sound financial architecture for anyone operating through an LLC, S-Corp, or C-Corp structure. Running business hotel expenses through a personal card complicates your IRS substantiation trail and, more critically, can create commingling issues that pierce the liability protection your entity structure is designed to provide. Many sophisticated users operate a Bilt card for personal travel and a dedicated business card, such as the Amex Business Platinum or the Inc. Business Preferred, for deductible corporate travel. That separation maintains the integrity of your entity structure while allowing you to maximize personal card benefits on non-business travel. The hotel credit on Bilt then becomes a clean personal travel benefit rather than a blurred corporate expense. One of the most underappreciated strategic dimensions of the Bilt card relates to credit utilization and its downstream impact on your future borrowing capacity. The credit utilization and Bilt strategy conversation is particularly relevant for business owners who are actively managing their personal credit profiles in anticipation of capital raises, real estate acquisitions, or refinancing events. The Bilt card historically carries a relatively modest credit limit for a premium card, especially in early months before relationship-based limit increases. If you are booking high-value hotel stays and running meaningful spend through the card, monitoring your utilization ratio relative to the Bilt limit is essential. Consistently operating above 30% utilization on any individual trade line, even if you pay in full monthly, can suppress your FICO score in the short window between statement close and when lenders pull your report. For anyone with a near-term financing event on the horizon, the tactical play is to request a credit limit increase before concentrating hotel spend on this card. Let me now be direct about the ideal Bilt 2.0 cardholder profile, because precision matters more than generalization in institutional analysis. The Bilt Hotel Credit delivers its highest net value to renters in high-cost urban markets: New York, San Francisco, Boston, Los Angeles, who are already using the card for its core rent payment mechanism and who travel personally rather than primarily for business. For that profile, the hotel credit stacks on top of an already compelling value proposition. The effective annual fee justification becomes straightforward when the rent rewards alone justify the carry cost. For frequent business travelers who primarily need hotel coverage for deductible corporate stays, a business card with hotel credits, such as the Amex Business Platinum's Fine Hotels and Resorts program, is almost always the superior structural choice. The deductibility, entity separation, and hotel brand loyalty credit preservation collectively outweigh what Bilt can offer in a corporate context. And for retirees or investors who own rather than rent their residence, the absence of the rent payment value proposition shifts the Bilt math considerably. The hotel credit alone rarely justifies card carry for that demographic when compared against competitive alternatives. Let us run the Bilt annual fee ROI calculation clearly. The Bilt Rewards card carries no annual fee, which is structurally an unusual characteristic for a card with this level of benefits architecture. From a cost of capital standpoint, a zero-fee card eliminates the break-even analysis that dominates premium card evaluation. You do not need to extract a minimum dollar amount of value to justify the carry. Every dollar of hotel credit and every point earned is net positive against a zero-cost basis. That said, the opportunity cost analysis still applies. Holding the Bilt card means the mental bandwidth, the spending allocation, and the portal booking behavior required to capture hotel credits all have a time value. If a competing card with a modest annual fee delivers higher net value, including hotel credits, transfer partners, and bonus category earning, after accounting for that fee, the Bilt card's zero-cost structure can actually become a trap that leads you to underutilize superior alternatives. Strategic cardholders run a portfolio, not a single card. Bilt earns its position in that portfolio specifically and precisely, not universally. Before we close, let me give you the summary of critical insights from everything we have covered, because this is the information that truly matters. First, the Bilt 2.0 hotel credit is real and it posts reliably. But it is portal dependent, and portal rates must be compared against direct rates on a per-booking basis to determine your actual net benefit. Never assume the credit creates a superior position without running the full comparison. Second, for business owners, the entity structuring question is paramount. The Bilt card is a personal instrument and should be treated as such. Commingling business hotel expenses through a personal card creates both IRS substantiation risk and potential liability architecture exposure. Third, the float period embedded in Bilt's billing cycle carries legitimate cash flow management value, particularly for high-income professionals managing quarterly estimated tax obligations. The after-tax value of a hotel credit on a deductible business stay is higher than its face value. Consult your tax advisor for your specific marginal rate situation. Fourth, Bilt's points transfer liquidity, specifically access to Hyatt and airline partners, adds optionality value that materially enhances the card's return profile beyond the hotel credit alone. That transfer ecosystem is a strategic asset, not a secondary feature. Fifth, for renters in high-cost urban markets using the card for its rent payment mechanism, the hotel credit stacks cleanly, and the combined value proposition is difficult to match at zero annual fee. For non-renters, or primarily business travelers, the structural fit weakens considerably. Sixth, monitor your credit utilization relative to your Bilt limit before concentrating high-value hotel spend on the card, particularly if you have a financing event within the next 6 to 12 months. The final verdict on Bilt 2.0 hotel credits is this. The program is a genuine enhancement with real, measurable value, but it is profile-specific in ways that matter deeply. For the right user, it is one of the most capital-efficient hotel benefits available at zero annual cost. For the wrong user, it creates friction, opportunity cost, and potential structural risk that outweighs the headline benefit. Run your own numbers. Compare your portal rate against your direct rate. Know your entity structure. Know your utilization profile. And position Bilt precisely within your broader card portfolio rather than treating it as a standalone solution. That is how institutional-grade cardholders approach every single product decision. And that is exactly the framework this card deserves. If this analysis provided genuine value, please subscribe for more free institutional-grade credit card strategy and financial analysis that you genuinely will not find anywhere else on YouTube. Click the thumbs up button if this video delivered insight worth your time. And drop your questions or content requests in the comments. I read them and I build content directly from what you ask for. Disclaimer: I am not your financial advisor. This content is for educational purposes only. Please consult with qualified professionals before making any financial decisions.